Hi everybody, this is Pawan Agarwal from Good Money Man, and I'd like to welcome everybody for the Indian economy and equity market outlook for the month of March. We'll start with the outlook on global economy. If you look at global economy, there's a mixed forecast for 2023. US Fed is still raising interest rates, inflation remains elevated, and China continues to puzzle with a very fast opening of the economy post-COVID. India, it is said that India will have a strong year. Bonds are going to make a good return. China's economy opening up. So likewise, the experts are divided about how 2023 will shape up. If we look at the headline, global headlines are full of negative news. A prestigious newspaper like Wall Street Journal is saying things that you have to skip breakfast if you need to save money. So, a professor is telling that Japanese senior citizens should kill themselves. Likewise, in UK, the tomato-free pizzas are added to the menu because of the price of fruits and vegetables. Likewise, German president is saying that homeless numbers may increase. So all of these things are causing a lot of negativity. China's top tech billionaire goes missing, and because of that, the share prices had a major downfall. Mark Mobius, a very reputed investor, made a comment that he's not able to get his money out of China. So, in terms of global wise, the things are looking a bit shaky. But जहाँ कुछ गड़बड़ होती है वहाँ कुछ better भी होता है. IMF has upgraded global growth forecast, which means that ये सारी जो problems है, this will slowly and steadily fizzle out and growth is going to be there. So global growth has of course slowed down, but now it seems to be bottoming in US, in Europe area, and in emerging markets and including in China. So at least growth outlook seems to be turning better for emerging markets. So things are moving for a better shape. When it comes to the manufacturing momentum, it's wonderful to see that India here, if you see that India is leading the manufacturing momentum along with Thailand here. So the growth is visible and it seems to be in the expansionary mode. China went through a COVID phase like India went through in 2021. And now, as China is back to operating at full capacity, there is fear that inflation across the world may end up getting on the higher side. When we talk about China, the problem for China is the real estate and the debt, because a large part of their growth, especially post 2000 crisis, came from real estate sector. And the real estate sector was funded, leveraged mostly out of the domestic debt. Now they've built many houses and cities for which there are no takers. Now, how will China solve this problem? We have to watch because it is of interest to a lot of people. What we have also seen that a lot of investors are holding on to cash. So how is this going to, because people are waiting and watching whether they should invest in equities or bonds. So it's better to put their money in cash and then decide which way the markets are turning. Now coming to US economy, Fed has raised interest rates quite dramatically, but they haven't reduced balance sheet as much as they should have reduced from subprime crisis. From subprime crisis till COVID, what they have done is that they have almost added 4.8 trillion. They have added 4.8 trillion, but they have taken out small peanuts, that is $626 billion. So is this sufficient? Who knows? Well, of course, the job of Fed is complicated, but then adding 4.8 trillion and taking out just 626 billion doesn't go side by side. Bankruptcies have started to increase from January at a rapid pace, and with little time to go, it may end up reaching subprime level crisis. US is heavily leveraged. US Fed's debt is fairly $31 trillion, leveraged by about 17 trillion household. Credit card debt is excess or near around $1 trillion. Look at these numbers and understand how heavily leveraged US is. If you look at the student loans and the auto loans, the numbers are mind-boggling. Well, as we have been saying in our past few videos, that Indian economy oasis in the global desert. So there are good things happening, but the sandstorm is still blowing. So we'll look at the good headlines and the bad headlines that are happening for us. In the deteriorating global background, if we look at Indian economy, it is doing reasonably well. Many headlines are positive, like on an incremental basis, 15% of the global growth this year will be driven by India. So this makes it a bright spot. Likewise, services PMI climbed to a 12-year high. They climbed to a 12-year high, marking a good positive impact. Agri exports touched 20 billion in first 3 quarters. The Kharif crop of wheat and rice production is at all-time high. So these are good points. The domestic average passengers are up 96% last month. The credit card spends are increasing. Indian core output sectors is increasing. Apple, because of PLI scheme, has been able to create 1 lakh direct jobs. So even if we just don't go down up to the indirect level of impact, which has happened by these direct jobs, this number itself is a game changer. Well, there were some headlines which were negative. For one, the inflation came 6.52%, ahead of RBI's target as well as market expectations. The third quarter growth of 4.4%, manufacturing PMI declines, and most importantly for us, there is a risk to the normal monsoon. So for India, which is so much dependent on agriculture as an economy, US agencies has given warning against El Nino. So we have to wait and watch its impact, but it might cause some difficult times if monsoons are not good. If you look at third quarter FY23, the GDP growth came at 4.4% because the last year the base was reasonably high. Within that, the services sector have grown, have gone up by 9.7%, construction and 8.4%. So all these are looking good, and power demand is 8.2. But at the same time, the real challenge for us has been the manufacturing, which has gone down. See, as a country, we have to grow at a rapid pace. We need to make manufacturing our friend and make sure that manufacturing is happening at the appropriate level. Government spending, which just went 2%, and also consumption. So all these data, they could have been better. Silver lining was the revision in last 2 years of GDP growth from 8.7. We were thinking that in FY22 our growth will be 8.7%, but then it happened at 9.1%. And likewise in FY21 the target was minus 6.6 and it was minus 5.7. So which clearly shows that we have underestimated actual GDP growth and real GDP growth has come ahead of initial estimates. So this is a silver lining for us. If you look at Indian economy, domestic activities, ये सारी domestic activities near all-time high चल रही है और capacity utilization is above long-term average. So ये सारी अच्छी चीजें हैं जो कि अभी हो रही हैं. PMI remains अभी भी expansionary mode में है. Services PMI, like I mentioned पहले भी, they have hit a 12-year high, whereas manufacturing PMI has declared marginally, but we need to make sure that ये वापस ना हो and we focus largely on that. GST collections के तो क्या कहने हैं, 1,40,000 crores has become the new normal. Tax collection growth is also now running almost near 20%. So all of this is good for the economy. Credit growth is now happening in double digit. So if you look at the credit growth here, it is all happening at double digit. Non-food credit growth is healthy at 15.3%. Industrial credit growth is almost at 14% mentioned here. And personal loans is running at almost 26%. So all of these are helping the economy. The agricultural growth continues to surprise on the upside. But there is a little bit of challenge here that if monsoon is not good, no thanks to El Nino, then this could cause a negative surprise for us. This is a very interesting chart I would like to share with everybody that normally ahead of election year, government spends money on building infrastructure, and we have seen that playing out in various cycles here, and here. So this is the election year, and just look that the amount of money that is being spent is huge. So we are hoping that the same will be done ahead of the 24 elections, and this could boost the economy a lot. Private sector investment has started improving as capacity utilization is above long-term average. The government has also increased allocation to the infrastructure private investment, which is also helping in pushing the overall investments into higher territory. अब अगर हम लोग मैन्युफैक्चरिंग की बात करें कि कैसे इंडिया मैन्युफैक्चरिंग की तरफ बढ़ रहा है, तो चाइना से जैसे जैसे मैन्युफैक्चरिंग कंपनीज बाहर निकल रही हैं, और जैसे जैसे ये जो थीम है कि चाइना प्लस वन हो रहा है, एंड स्पेशल थैंक्स टू आवर पीएलआई स्कीम, we are getting a good traction. So of all the companies, of all the 135 companies that have moved out of China, we have gotten 14%. And what are these companies coming to India and manufacturing? Well, they are making electronic automobiles, components for electronic toys, and all those kinds of industry. And we are getting a lot of benefit out of that. The government capital expenditure is expected to go up by 20 plus in FY24. And thanks to the election, a majority of this will be spent in completing or in faster execution of infra projects. And as we all know, infra में अगर पैसा जाएगा तो देश में और बढ़ेंगे. Employment data remains robust. Things have been positive at this front. Inflation for FY24 is likely to remain below RBI's target range of 6%. People are expecting to be inflation to be somewhere around 5.5%. While inflation, the largest driver was coming from the food inflation, and especially if monsoon gets affected by El Nino, then the food inflation can spike up, and this will cause a little panic. So let's hope and pray that El Nino doesn't cause and disturbs the monsoon. Well, one good thing for us has been the oil prices coming down, because it has been a blessing that it comes from triple digits to here. And if oil remains around this level, our economy will be doing well. We had mentioned in the past that India's trade deficit continues to remain well ahead of our comfort zone. Well, there has been a silver lining in the dark cloud. The trade deficit for January came at a much comfortable level of around $18 billion, where thanks to the import contraction, trade deficit declined from $25-30 billion a month to $18 billion. For us, the weakness continued to remain in consumption. Many of the listed FMCG, as you can see, we have taken examples of these companies, and here are the numbers. Many of the listed FMCG companies showed either low volume growth or negative volume growth. If we look at the December 22 numbers, you can see the numbers have not been that great overall. Is a cause for the Indian economy, because as the volume growth remains muted on the consumption side. Now, this volume growth is driven by rural economy, where rural FMCG for last 5 quarters is witnessing a negative return. As you can see here, this is the chart for the rural market and this is for the urban market. The growth for the rural FMCG for the last 5 quarters is negative, and in urban market the reversal has occurred in the last 3 quarters. Obviously, what has happened in urban market in terms of recovery need to be replicated. The same thing has to be done for the rural market as well. If we look at the consumption level, अगर हम देखें कि अगर प्री कोविड ट्रेंड जैसे हमारा कंजम्पशन लेवल बढ़ रहा था, अगर कोविड नहीं होता तो ये कंजम्पशन का लेवल कुछ इस तरह होता, बट आज बिकॉज ऑफ कोविड वी आर हियर. सो ये जो गैप है, this gap needs to be filled, and we need to support consumption for this. If we look at this data, this is again a very interesting way to look at the consumption. The credit card spend is increased. अगर देखें तो क्रेडिट कार्ड का स्पेंडिंग यहाँ से यहाँ आ गया है, डेबिट कार्ड का उतना इंक्रीज नहीं हुआ. अब क्रेडिट कार्ड क्या होता है? क्रेडिट कार्ड इज normally given to people who are rich, whose credit is beyond doubt, and debit card is used by people who have bank account and you don't want and generally don't get access to credit facility. And if these people are not spending, then this means that consumption at their level is adversely impacted. ये आप देखिए जनवरी 21 में क्रेडिट कार्ड का स्पेंडिंग इतना था और वो और कम हो गया, बट क्रेडिट कार्ड का अगर हम देखें तो इट हैज बीन pretty decent. Well, the putting all of this together for India has many bright spots and of course few causes of concern. Right now, consumption trend, however, will make and break the country. India will differentiate itself on the 3G growth. Growth for our earning, growth will be superior to our peers, will make sure that our governance is all right, and of all the growth that is happening, we have to make sure that we are doing it sustainably with proper care for the environment. And as long as we do that, foreign investors will continue to invest in India. Now, this is an interesting chart. In this century, what I'm trying to say, please understand that in this century, that is 2000 to 2022, 2000 to 2022, only two countries, India and China, as you can see in the chart, has increased their GDP relative to US. Here is China and here is India. So, and if you look at the other countries, Japan, Germany, UK, France, Italy, all of them have come down. China has taken a big leap, as you can see in this chart. India could not take that much of a big leap, but sure, things are turning around and we can make a lot of impact. So this century has been good for China and India. However, India is reaching sweet spot where our share in global GDP is set to expand from 3.5% to 4%. We are on the trajectory. Over the next few years, we are definitely going to reach there. Now, coming to the equity markets, we continue to trade at significant premium to our own peer group. We are 3 times more expensive. So if this is India, this is Brazil, China, and South Africa. So we are 3 times more expensive than Brazil, about 1.5 times more expensive than China and South Africa. So well, this has resulted in short-term investors moving. क्योंकि इंडिया का वैल्यूएशन इतना महंगा है, तो क्या हुआ कि जो भी इंडिया के इन्वेस्टर्स हैं उन्होंने यहाँ पे प्रॉफिट बुक करके इन चीपर मार्केट की तरफ वो लोग चले गए. बट दिस इज अ शॉर्ट टर्म स्ट्रैटेजी एंड दिस विल नॉट कंटिन्यू फॉर द लॉन्ग टर्म. चाइना बिकॉज ऑफ इट्स साइज उसको बहुत ज्यादा इन्फ्लो मिला है, बट उसके वजह से कोई खास परफॉर्मेंस नहीं मिला, बल्कि द परफॉर्मेंस हैज बीन वेरी वेरी अनसैटिस्फैक्टरी. Well, on the other hand, the emerging market Asia hasn't received as much flow as the whole of China alone has received. As of today, we believe that the growth differential now favors emerging market. emerging markets will do better than US and developed world in terms of growth rate. Now, if we compare India vis-a-vis the peers, we come out in the top quartile of ranking. Our valuation premium vis-a-vis to the rest of the peer group has come down, but it is still, still above the historical average of about 79%. If you can see here, where we are trading at 122% premium. This is all thanks to the domestic institutional investors, all the people who are investing in SIP, all thanks to you, that you have become a big part and big supporter when it comes to absorbing the selling which is done by FPIs. So if you look at October 21 to June 22, this were the buying powers of DI, similarly for July 22 to December 22, and likewise for Jan Feb. So it's wonderful to see that Indians are putting so much of money in their own markets. Well, if we look at it from a valuation point of view, we continue to trade at or around our historical average, historical P. And our historical P is around 18.4 times. Currently, we are at 17.7. So, we believe earnings will be revised downwards, and we might be trading somewhere around 18.5 1 year forward based on the downgraded earnings on a price to book. We continue to trade at a marginally premium of long term and average of 2.6 times. So this is for the 1 year forward P by B, and this is for the P. Market capital GDP ratio at 95 is above historical average of 79, and but it is significantly lower than 112, which it had reached last year. Now, the December 22 quarterly results were kind of mixed. In the banking and financial sector, the results were well above expectations, but the risk of the sector's results were a little below. The earning per share forecast of Nifty 50 has revised modest cuts, and we believe that for 2025, the EPS of Nifty could be anywhere between 1070 to 1074 per Nifty share. Here, as you can see what I was talking about, the EPS of Nifty. This is very interesting chart. So all the various companies in NSE 500, if you look at the transcript and read, you will find out. Please pay attention. This is something very interesting. If you read the transcript and find out, 386 companies have talked about macroeconomics in their macro environment in their conference. 299 have talked about slowdown in their business. 84, 299 for slowdown, 386 for macro environment. 84 companies complained of margin compression, and 59 companies talk about capex growth, which is likely to support growth in days to come. Clearly, on one side, corporates are worried about, because of the macro situation and slowdown, but at the same time, they continue to remain bullish for the investment in capital expenditure. It will be fair to say that next year and this current year, the next financial year will be full of volatility. But without sitting in the roller coaster, we are not likely to get the experience of the fun. So, what would be our equity opportunity? Our equity advice is to use SIP as a vehicle. Use correction as an opportunity to increase allocation to equity, and don't chase the momentum. So what you don't have to do is don't follow the momentum. What you have to do is that you have to stay invested and whenever correction comes, use that opportunity to increase your equity allocation. I would like to end our presentation with this particular slide. This is the 10-year alpha of Berkshire Hathaway company that is run by the gods, popularly known as Warren Buffett and Charlie Munger. As you can see, that God can also underperform the market. This is a 10-year alpha of Berkshire Hathaway over S&P 500, where there were periods where these people outperformed S&P 500 by big margins. There was also a period where Warren Buffett and Charlie Munger were generating outperformance by a smaller margin. But if you look for the last 10 years, you will find that Berkshire Hathaway has underperformed S&P 500 total return. Well, the reason to show this chart at the end with you is that all the fund managers are also human, and nobody can guarantee good performance every year after year, every day, year after year, every month. So just to put things in perspective, make sure that you are investing right and following the right way. With this thought, I would like to end our Outlook session. Have a great day. Thank you.